Hello and welcome to Kitco Mining's Digging Deep with me, Paul Harris, in which we look at some of the most interesting news in the mining and exploration space. We are live in person, well, we're not live, but we're in person here at the 2025 Mining Forum Americas in Colorado Springs, and I have the great pleasure to be joined by Nicole Adshead-Bell, the Director of Cupel Advisory. Nicole, welcome back to Kitco.
Thank you very much for having me. We're in a bull market. It's great to be here.
It is, and we're doing this at the end of a very intense couple of weeks. We were at the Precious Metal Summit last week. We're here at Mining Forum Americas. Lots and lots of meetings, lots of gossip, lots of talk. How have the conferences been for you? What are some of the things you've learned that you didn't know before?
Well, we're definitely in a bull market. There has been a material increase in positive emotion versus last year, even though we were in very strong gold prices. And so you're seeing that reflected, and everybody's very, very happy. There's been numerous talk of financing, so you're seeing that associate impact where it's much, much easier to raise money. There's private companies that are coming out raising $8, $9, $10, $12 million, something that would have been unheard of even last year. So all the signals are suggesting that the bull market is here, and the market is going to be focused on, investors are focused on growth and focused on how do we get positioned, and with a new wave of investor types as well.
Okay, we're going to dig into some of that. For me, it does seem that people were here, sleeves rolled up, looking to work and work hard, rather than being celebratory and partying because gold is at record price levels.
I would agree with that. Everybody you speak to, I don't know if we're all just getting older, so party less, but everybody is here, back-to-back meetings, and part of it is there's a lot of opportunity now. We know that we're not at the top of a bull market, there's time to position yourself, and so this is where the hard work has to be done.
You ran a Mining 101 course here at the Mining Forum Americas. What was the aim of that? And why was that? That was a new thing this year. Why? It
was a new thing. Tim Wood reached out to us. I'd given a keynote presentation last year, and then Neil Hadstead had given one at the Zurich Gold Forum this year that had some positive reception. So he asked us, basis on the fact of from feedback of generalist investors that were coming to the conference and saying, look, we're very interested in mining, but our level of understanding in terms of the technical aspects of it and the questions that we should be asking in meetings, we would like some help with that. And so he asked us to put together a short course. It was very well attended. It was mostly generalist investors that were very, very engaged. You could see them taking notes the whole time. It was a 3-hour short course, and half of them stayed behind for half an hour of additional questions, and 3 or 4 of the super keen ones stayed for an hour. So there was a lot of interest, and I think that's the leading indicator of where this market is going. Generalists are definitely doing their homework. I don't think they're in the sector in a material way yet, but we will start to see more of those marginal inflows, which of course drive share prices higher.
Because of course it is quite a steep learning curve, isn't it, to grapple with mining stocks?
It's a very steep learning curve, although ironically in a bull market, I'm not sure that you need to understand the technical side of the business because everything goes up. And in fact, often it's the companies that perhaps have the assets with some hair on them and more highly levered that outperform. So
I am starting to hear investors complain that they're only making 50% gains on stocks rather than triple digit.
Yeah, look at the ETFs, up 100% this year. I mean, if that doesn't tell you we're in a bull market, I don't know what does.
Okay. Now, you mentioned that gold producers are making some serious money now, so one of the conversations has been on capital allocation and what they're going to do with the funds that they're getting that they perhaps weren't expecting. Exploration seems to be increasing, exploration budgets are growing, investment in capital budgets on projects, expansions, things of that nature. Things being accelerated because of having extra capital available, and of course returns to investors and perhaps in the future M&A. What are some of your expectations for capital allocation and how that's perhaps evolving in this market?
The big change between investor presentations, and I've sat in a lot from the Precious Metal Summit and also Mining Forum Americas, is a real focus on growth. The messaging has really changed from capital discipline, I would argue, to one of growth. And where is our growth coming from? And we're seeing those companies that have got demonstrable growth or have completed M&A in the last year, they're getting rewarded for that. And so I think what will happen is when companies are meeting with investors will saying, well, where is your growth coming from? And what normally happens with that is you start seeing higher risk capital deployed. So exploration, hopefully geologists are taking this as a chance to actually charge themselves out for what they're worth. Let's start charging lawyer rates because we're the foundation of the industry as we know it. But also M&A, the classic behaviour that you see as prices start to rise is an increase in your underlying commodity price assumption to grow your reserve base, not through discovery or drill bit discovery, but through decreasing your cut-off price assumptions. So I think we'll start to see that start to trickle through. So across the industry, increase in reserve price, commodity price assumptions to calculate reserves. M&A, I think that theme is going to continue, and we're going to see M&A go down the food chain. So we've already seen the developers, which were unbelievably unloved over the last probably 3 to 4 years, and you and I have talked about this, that suddenly the developers are re-rating. And why they're re-rating is, number one, they were very, very undervalued, but there's also this expectation and anticipation that this M&A theme will continue, and it will continue in the developer space. And what normally happens is FOMO drives boards and management teams, and that's when you start seeing above precedent transaction premiums paid and also competition for assets, because the easiest way to grow your resource and reserve base is to acquire it, not to find it.
Well, I think that's quite interesting impression, Nicole, because when you look at the mid-tier companies, their numbers have swelled in the past year or so because Newmont's divested assets, Barrick's divested assets as well. So there's an increasing number of single asset producers out there with zero or almost zero pipeline. And so obviously they're going to have to look to get some pipeline, get a growth possibility. I also think although the share prices have increased, some have increased more than others, so there does seem to be leverage in some companies' paper relative to who they may well look to buy. What kind of M&A transactions do you think are going to happen?
I think we're in the sector where you get rewarded for getting bigger for the sake of getting bigger will result in outsized share price performance, and that's because size begets liquidity, begets a different range of investors. Don't forget, for generalists, $1 billion company is considered small cap for them. So it's how do you as a corporation attract the widest range of investors? Also, single asset companies are materially exposed to single asset risk. So if something goes wrong, obviously it has a very negative impact to your business as a whole. So to de-risk your business, you're encouraged to get together. And so I think we've seen this initial divestiture process with the larger companies divesting themselves of non-core assets, and obviously a bunch of single asset companies. And then I think you're going to see consolidation again. So, and normally what you see with larger companies is they're not normally divesting assets at the top.
Okay. I think this sector is wonderful in many, many different ways. We're seeing companies whose shares prices have increased by triple digits, 100%, 200%, 300%, even 500%, and yet CEOs still say they're undervalued. It's wonderful. As an investor who can perhaps take a sang-froid view of things, what are the valuation metrics that you really look at? Because every company puts out the valuation metrics that really suit them or show them in the best light. Which ones do you look at?
I think the best arbiter is true free cash flow, and then obviously free cash flow per share, because that allows you to compare across the sector. And then how do you also incorporate growth? Because we know that investors are paying for growth, so you want to include that in your metrics. And so maybe free cash flow per reserve ounce or resource ounce is also another way to look at it. But to your point, I just sat in a whole number of presentations, and it's startling how every single management team gets up there, they show a whole range of different metrics, and all they're trying to do is show how undervalued they are. I would argue you should be trying to point out how well valued you are, because if the market is willing to give you more value than what you're actually worth, that's a management premium. That means you're doing an exceptionally good job. And arguably you could argue the reverse, that if you're deeply undervalued, well, maybe that's something that management needs to look at. And so I would argue, though, is that if you're overvalued on a relative basis, you need to act. And that's either acquiring something with your paper, or it is issuing equity, which is maybe a harder thing to justify because many companies are producing a material amount of free cash in this current gold price environment. But if you don't act on a relative basis, then ultimately you will trace to fair value. So I think most companies need to be very, very objective about their value, and they always reference analyst consensus, but analysts don't know exactly what's going on in your business. You know what's going on in your business. And so management teams and boards need to be having rigorous discussions about what do they think their defendable NAV is, and that should be driving strategic decisions.
Now, earlier in our conversation, Nicole, you mentioned something that is a key talking point at events like this, and that's the gold price that are used to value reserves, resources, and other things. The delta between the spot price and the prices used there has perhaps never been bigger. A bit of a head scratcher there. companies are sort of perhaps limited by the 3-year rolling forecast that the banks have, so they can't perhaps stray away too far from that. But because they're using let's say a 3-year average, that's always going to be in a high price bull environment like we're in now. That's always going to come up with figures that are far from reality. So we've heard a number of the big companies saying that at the end of the year they're going to increase their gold price figures. Barrick Mining, Mark Bristow, he told me that they're going to value their reserves. They're going to bump that up to $1,500 per ounce. Their resources up to $1,900 per ounce. Still quite a delta there. What are you seeing elsewhere in the space?
I mean, one thing you can be guaranteed with commodity price forecasters is they're always wrong. And partly the reason for that is if you're within the herd forecasting commodity prices and you're wrong, that's okay. You step outside of that herd and you're aggressive and you're wrong, you're probably going to lose your job. So I think we just all need to acknowledge that they're going to be wrong. The best way to be looking at the sector, I think, is what is the forward curve saying? Because that means you could theoretically hedge all of your production based on the forward curve today. So I think the forward curve is perhaps the best indicator of price. The one thing to be aware, and we saw this in last cycle, is you had a very dramatic increase with all companies increasing their commodity price assumptions to calculate their reserves and their resources, and they were doing that as gold price was topping. So I think that there should be an understandable hesitancy, and what we want to see in this cycle is how do we capture true margin expansion? And the way that you do that is to maybe maintain a more conservative gold price assumption as the gold price is going up. But then in doing that, you'll ultimately hurt yourself because everybody else is changing their gold price assumption. So I think it's an interesting strategic line with which you have to walk. But we also have to acknowledge that no one's ever going to call the top, no one's ever going to call the bottom. This time is different is the most terrible advice you'll ever receive. We're in a cyclical commodity price environment, and we've basically been in a bear market for the last 10 years. And so how long this lasts, I don't think anybody truly knows, but we're yet to see, for me, what are signs of being in the top. And the signs of being bubble territory is when you're getting generalists coming in mass. We are not there yet, and it's when you start seeing 100% premiums paid for M&A transactions. So we are definitely in a bull market, but we're not yet seeing the crazy bubble-like behaviour that is always the indication that you've reached the top and it's time to sell and sell very quickly.
I think in a couple of years' time we're going to see this play out in a very interesting way with the Nevada Gold Mines and Barrick Mining with the 4 Mile deposit, and we'll use that as a means to get into talking about some of the news stories. Barrick Mining released a PEA, preliminary economic assessment, on its 4 Mile deposit in Nevada, outlining average annual gold production of up to 750,000 ounces a year at an all-in sustaining cost of up to $750 per ounce for 25 years, following an initial capital cost of up to $1.7 billion, and the likelihood of doubling its high-grade resource there. CEO Mark Bristow is a geologist and clearly excited by drill intercepts of hundreds of meters at hundreds of grams a ton there. 4 Mile, I think, that has really surprised everybody. People knew it was coming, people knew it was going to be good, but did people think it would be that good?
I think you've actually 2 very, very sizable discoveries in the Nevada region, and because of that location and the mining history and the political risk, will always be more highly valued anyway, but that's Anglo Gold with its Silicon, now Arthur Project, and of course 4 Mile. So I think what this says is if you actually put some money towards exploration and you pay some really good exploration geologists to help you with your strategy around exploration, even in very old districts, you can find very, very material discoveries. I think it's fantastic for Barrick. I think it's fantastic for the industry. And it is interesting how Barrick's messaging has changed. At this conference last year, they were very focused on copper. It was in the title of their slide, and the messaging was kind of, I would like to be a copper company when I grow up. And now there is a refocus on gold, which I think makes a lot of strategic sense, because you're not going to buy Barrick for copper.
Barrick has been very, very adamant about not raising gold price estimates to be able to have a business that's sustainable at a much lower gold price. But with 4 Mile, with Barrick having the option to put 4 Mile into Nevada Gold Mines at some point in the future at fair market valuation, presumably he'd want a much higher gold price in that fair market valuation. I understand BMO put a note out this morning. They estimate at the moment it's valued about $18 billion. Nicole, that creates perhaps an interesting strategic question for Newmont's board. At that point in the future, do they look to buy it for cash and give one of their main rivals billions of dollars in cash? Do they dilute down in Nevada gold mines? That's going to be a tough one for them.
I think it's partly is tier one assets are unbelievably rare, and you always have to overpay for them. In our industry, where the average in the gold mining industry, and I think it's one of the reasons why you saw some of the gold miners be attracted to the copper gold porphyries, is the average life of mine when you first start is 10 years. And so you're constantly having to replace a depleting asset. So when you have an asset like this that has the potential to have a very, very long life of mine, how do you model that value? Because on a traditional modelling metrics using a reasonable discount rate, anything past 10 years is essentially de minimis in value, but it has enormous strategic value. And so I'm sure that the Newmont board is having those discussions. What are we comfortable with as a long-term gold price? Where does this fit with us strategically? We're in a market again that rewards you for growth, and you have to acknowledge that. So if you buy something, even if you overpay for it, and you see that reflected in your share price, you have the chance to maybe it's dilutive on a couple of traditional metrics, but if the market's going to reward you for it, you then have the chance to use that price that maybe gets reflected in your paper to do other things that are more accretive. So I think it's a really interesting strategic discussion, but the Nevada assets have shown time and time and time again these kind of assets that their value is immense, and I don't know how you value it's tough to value. You can't use traditional valuation metrics. Speaking
with various CEOs at this event, I do get the sense that they feel that the market underestimates or underappreciates or undervalues what they have. I spoke with Clive Johnson, CEO of B2Gold. Goose is coming into production, and he says that's going to throw off crazy amounts of money that the market doesn't appreciate. I spoke with Jody Kozinsko, CEO of Torex Gold Mines. She said when Media Luna starts really coming in, it's going to use her words, it's going to generate a crazy amount of cash.
Well, no CEO is ever going to say the opposite, so I would argue they're a little biased in terms of how you value your own assets. But my response to that is, if you don't think the market is recognising the underlying value, it is up to you to message it. And an investor literally has 3,000 companies, publicly listed companies to choose from. So how do you stand out from the crowd? Number one, you have to make it as easy as possible for them to do the work, because they're not going to do it. So it's around how do you message it and how do you attract those marginal eyes. So, and I think what you tend to see is those companies that trade at the biggest premiums are the ones that are probably the best at messaging their business very proactively. Something as simple as making all of your quarterly financials downloadable in Excel. So you have to be having a mindset that an investor has a lot of pretty things that they can play with at the moment. How do you make them notice you and want to own you? And I think complaining about relative valuation probably doesn't help. You need to get out there and you need to message and sell your story in a way that resonates with the other side.
At a very basic level, I think you should have your quarterly financials actually on your website and not direct people to Cedar Plus or Edgar or wherever.
You would be amazed how even large companies, you have a technical report, you make me go and spend time with Cedar, which is the most horrific website to work your way through.
Agreed.
And investors equate transparency with trust. So if you overshare, sometimes on a personal level, having someone overshare is, no, you need to be quiet now. But a company that makes it as transparent as possible and actually overshares. And I think Agnico, case in point. I mean, there's a reason why Agnico always looks kind of expensive on a relative basis. Has outperformed everything. You can almost look at any time period, and it's outperformed all of its peers and the GDX and the GDXJ. And there's a couple of reasons for that. Their messaging is very simple, very clear. You go to the website and you can find anything that you want to know without having to speak to management. And so if I was a management team and board, that's what you need to be doing. You need to say, someone can make an investment decision in my business without having to talk to me.
Okay, more M&A. Barrick Mining, as we mentioned earlier, is selling its Hemlo mine in Ontario to Carcetti Capital for just over $1 billion US dollars. Who is Carcetti Capital? It used to have energy investments in Ukraine, but sold those because of the war. And it's been looking for something to do ever since. And so it does seem to be a very sort of manufactured deal in the best sense of the term. Wheaton Precious Metals is providing $400 million for a gold stream, which will end up being quite expensive, I think, for Carcetti at current gold prices and higher gold prices in the future. Orion Mine Finance will provide $200 million of debt there, and there'll be a concurrent $415 million equity financing, in which Wheaton will take $50 million. Carcetti doesn't really seem to have any mining experience, so it picks up Robert Quartermain to sort of lead things to build and manage the mine. Nicole, as I mentioned, this seems to be a very manufactured deal, an idea that got financed, possibly Wheaton Precious Metals acting as a kingmaker or kingpin to hang it all together. Is this a portent of things to come in the sector?
The fact that they could raise that amount of money that quickly, I think, again, is a good leading indicator of where we are in the market. I would agree with you about the stream. Putting a stream on your primary commodity, it can look at one point in time can make a lot of sense, but the higher the gold price goes and the greater your reserve base grows, the more dilutive that becomes on an asset level and can become a very, very expensive form of financing. But it's happened very quickly. I know Bob Quartermain quite well because I was on the pre-em board with Bob. He worked at Hemlo back in the day, so is very, very familiar with it. And it's the kind of story that will resonate in this market because it's new. And what you tend to see is newness sometimes attracts an over-interest, if you will, from the investing community. So, yeah, it'll be an interesting one to watch.
I think it sounds like it's a great deal for Wheaton Precious Metals. Wheaton Precious Metals is one of the two big names in the royalty and streaming space. Does this illustrate that it's getting harder for those big companies in the royalty and streaming space to get deal flow, in as much as they have to go out there and actually try and manufacture deals, perhaps acting like an investment bank, putting people together saying, hey, let's do this, we'll put some money in? Yeah,
when you think about it, really the streaming and royalty companies, they're financiers. And they get paid extraordinarily well to be financiers. What has happened, the big change over the last 10 years is you used to only have 2 or 3 main royalty / streaming companies. Now you have, plus 20, all competing for a finite amount of product. And companies like Franco and Wheaton, and even put Royal Gold in that mix, they need to do very, very big deals to move their needle. And so obviously very well connected these groups are, and I don't know exactly what Wheaton's role, if it was someone coming to them or if they were behind the scenes, but it does make sense that you will start to try and manufacture deals, because how do you do things if it's a company, and you see this in the base metal space or the non-precious metals, that wants to stream a non-dominant commodity, that's going to go out to all and sundry, and is a very, very competitive process. And so how do you have more of a control over the outcome? You start generating deal flow yourself.
Okay, a very different M&A transaction. Newmont is to sell its Coffee Gold heap leach project in Yukon in Canada to Fuerte Metals for up to $150 million. Sounds like a great deal for a great price tag for Newmont, but only $10 million of that is cash. Upon closing, $40 million in Fuerte Metals stock, and Newmont will receive a 3% NSR royalty, which Fuerte can repurchase for up to $100 million. Newmont has been looking to offload, divest coffee for quite some time, and the payment terms make it appear that Newmont wanted to get rid of this for almost any price, just get rid of it, get it off its books.
Yeah, well, they paid $500 million for it, if I recall correctly, and have sold it for a much greatly reduced price. I think they've spent around $200 million on it since paying. So, they are really focused on cleaning up their portfolio, if you will, and every asset that you have will have holding costs and material holding costs. So yes, I would say they just want to get this off their books. The Yukon, the biggest challenge in the Yukon, it's infrastructurally challenged, and particularly around power. And so you've seen an MOU between BC and the Yukon about extending the BC power grid, but in the short term, and I was at a conference where there was a Yukon panel and visited a bunch of Yukon assets in July that were run by Yukon Invest. So the government is very proactive about trying to encourage investment dollars. But if I was them, what I'd be encouraging from a permitting perspective is small modular nuclear reactors, because that's the biggest hurdle to things rapidly advancing, I think, in the Yukon. Now,
we in our previous comment about Hemlo and the company that's buying that, you mentioned Robert Quartermain's taking the reins there. He's very, very experienced. With this coffee transaction, coffee's on a path to complete its permitting, and therefore presumably very close to being able to get into a build decision and construction decision. Fuerte is the CEO there is Tim Warman. He's an experienced geologist. Is having an experienced geologist the right skill set to have to go into what's going to be a development and mine building story?
I think a CEO is one of the only positions in a mining company that you could have any background, because your job as a CEO it's glorified investor relations. We just had a chat about how do you stand out from the crowd. It's really about how well that you communicate and message your story, number one. Number two, it's hiring the best team that you possibly can with the resources that you have at hand, and also listening to that team. And it's also firing people when they're we always talk about hiring best people, but we don't talk about getting rid of the people who are a material detriment to your company. And then it's about being able to understand strategy, short, medium, long-term strategy, and obviously working very well with the board, but it's about directing the symphony to some degree. And so I don't think you can have CEOs, very, very effective CEOs that can be financial background, they can be a geology, they can be a mining engineer. So I don't think there's a particular background, but what we do see is kind of themes in our sector. We went through this time when all CEOs were ex-COOs, and just because you're a very good chief operating officer doesn't necessarily mean that you're a good CEO. And then we saw financial guys, so we saw ex-CFOs become, so you tend to see there's almost these themes in the sector, and I honestly, it's down to the individual and their ability to manage a company the best that they can with the resources at hand. And I think the absolute key ingredient for an effective leader is not surrounding yourself by yes people and listening to people that have got skills in areas that you don't.
Okay, now a sign that better days are here to come maybe is that Sprott launched an actively managed fund for the mining sector focused on industrial and critical minerals. Earlier this year, it launched a similar fund for precious metals. It's called the Sprott Active Metals and Miners ETF, providing the dual benefits of the liquidity and low cost of an ETF with the flexibility of an actively managed fund. Nicole, this would seem to be a very bullish sign.
Yeah, it's a very bullish sign. Sprott make a lot of money off fee generation, and obviously if you want to generate fees, you have to come up with new products, and you come up with new products when you think there's demand for that. So you tend to have new products tend to arise in a more of a bullish environment because you want to be able to sell those products.
Now this perhaps echoes the course you've just done, because obviously with an ETF, it means that generally investors don't necessarily, they can get exposure to the mining sector, in this particular instance, the critical minerals companies, without necessarily having to go up that learning curve.
Exactly, but I think what you tend to see in bull markets is maybe when someone's first investing into it, they'll nibble away at an ETF, but then you're seeing outsized performance in individual names, and then greed starts to kick in and go, I want some of that, so I need to understand and I want to be exposed to some of these individual talking names. So I think you do tend to see a bit of a transfer as investors think that they understand the sector better.
Okay. Big financing news out this morning with Qatar's sovereign wealth fund, QIA, to invest $500 million into Ivanhoe Mines. Interesting there because Saudi Arabia's PIF funds missed out on investing in Barrick Mining's Reko Diq, which we've spoken about in Pakistan. But it underlines the fact that Middle East countries want exposure to metals and mining, and particularly copper. Is this a sort of a transfer of the locus of influence of capital?
I think so. I mean, obviously these Middle Eastern countries, they have a huge amount of oil-related wealth endowment, and so you've seen a bit of a focus on diversifying out of that. I think Robert Friedland-related companies probably have the lowest cost of capital in the business. I'd say negative, and I think anybody that wants to invest in the mining sector, you probably know it's a fairly safe pair of hands, and Robert has been. Whenever you see where he's going or he releases on Twitter, etc., he's been spending a lot of time in the Middle East and building those relationships as well. So I think you're going to start seeing more and more money getting deployed from different sources, which is fantastic. It's fantastic for the industry. But the struggle is how do you as an individual company get in contact with those capital providers? And when you've got the reputation and the history of success that any Friedland-related company has, it's going to be much, much easier.
Okay, let's end with the World Gold Council and the launch of its new video to promote gold, which features Sir Elton John. It's a fascinating watch for music fans, I think, as Sir Elton talks about his affinity for gold, his love of gold clothes, all the gold awards he's won, and as he gets to be an older man, how the medical devices that use gold are keeping him alive. I grew up in the 1980s as part of that Generation X cohort, and I think it's fair to say our cohort considered him a fossil back then. So I imagine the younger generations today will simply ask, who's that, Grandad?
I don't know what the World Gold Council is doing. I honestly don't, except spending a huge amount of money. Maybe it's someone in the decision-making hierarchy that wants to be able to boast that they've had dinner with Idris Elba and Elton John. But I do not think this is an effective way to message gold. In fact, my response was, who cares? So why not put some of that huge amount of money that you must be paying these guys to having a very well thought out public relations program, hire the best media relations firm in the world, hire a bunch of millennials who understand, it's not just talking to the old people in the room like us, the middle-aged people in the room like us. It's also, how do you win the hearts and minds of the younger people? There's this guy on Instagram. He has 4 times as many subscribers as the World Gold Council does. And what he does, so he's not young, he'd be in his late 50s, early 60s, and he's talking about oil and gas. And he's talking about what makes oil and gas prices move. And I'm going, that's an individual that's not getting paid to do that has generated a huge amount of interest on oil and gas, which is the most even more hated than mining. Who's doing that in mining? Nobody. And if the leading advocacy organisation of the gold, I went and did actually read on, was the Idris Elba documentary well received? And if you ask ChatGPT, of course we always ask ChatGPT, it was actually quite critical. Said yes, it was widely viewed, but it was mostly fairly negative comments saying, it was biased and long form content, I think a lot of people don't even watch anyway. So, but the one thing I would say is in my presentation last year, I criticised the whole entire industry with respect to this. We're very, very poor at messaging what it is that we do. And we don't even use the low-hanging fruit like having Instagram and might have Twitter or you might have LinkedIn. And I did use the World Gold Council as an example of that they weren't even using Instagram and TikTok, etc. But now you look at their website, they do have those things. So I think they're listening. I'm not saying it was because of me, but at least you're starting to see a change. But honestly, how do you even show that helps?
Okay, so just to sum up that, very, very good points there. You don't see value in Sir Elton talking about enclosing his patellas, which are his kneecaps, in gold as promoting the gold cause.
I'm not sure that helps us at all, frankly.
Okay. Imagine it would have been much better or much more effective if the video would have featured Taylor Swift, because she has a lot of gold, a lot of bling in all the things she's done. And of course, she's probably got as many gold records as Sir Elton now. Okay, Nicole Adshead-Bell, this has been wonderful. Thank you very much for joining us today.
Thank you very much, Paul.
And we'll be back with some more Digging Deep in the future, so hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.